A few months back, a client sat across from me with a mortgage renewal coming up. The mortgage balance was about $750,000. The rate they offered was pretty strong at 3.99% fixed, and they had about 20 years remaining on their mortgage. So like I do with all my client calls, I said, hey, what are your goals with this renewal? Are you running into any cash flow issues? Do you have any debt? Are you looking at re-amortizing? What is it that you're hoping to do with this mortgage? And the client responded saying, I want to just pay this mortgage off as quickly as possible and pay the least amount of interest possible. And that's not a surprise because that is most Canadians' goal when it comes with their house. Perfect. So we decided to run the numbers on their scenario and found that they could actually afford to pay off their mortgage in 12 years instead of 20 years, and they were able to save over $100,000 in interest. The crazy part is that it doesn't require any more savings, it doesn't require any more earnings, it doesn't require them to invest. It just requires a smarter mortgage structure. The strategy we chatted about is called the power of the paycheck, and I'm going to break it down today. Before we get started, my name is Austin Ye. I am a mortgage agent in Canada. I work with well over 30 lenders across the nation. I've also been investing in real estate for the past 6 years. I've scaled a portfolio of over 20 rental properties. So when I talk about debt, when I talk about investing, this is not only just theory, this is from my personal experience as well. So here's what the client came in with. Their property value was about $1.2 million. So you can see we enter that in our calculator. Balance is $750K, rate is 3.99%, maturity is the beginning of August, monthly payments, 20-year amortization. That works out to a monthly payment of $4,527.97. This is significantly higher than their current rate just because this is a renewal, right? They had a much lower rate. It is what it is. This is what's happening in today's climate. They're not looking at re-amortizing. They want to pay off the mortgage as quickly as possible. There's no penalties incurred here just because this is happening at renewal, not before renewal, right? If the client had debts, we would enter it here, but in this case, they don't have credit card debts, they don't have car loans, they're debt free. But we can run the analysis assuming debt as well, if that is in your specific scenario. And then we talk about cash flow. As we can see here, the client's net income after taxes, CPP, EI is $16,000 every single month. So we're talking about a very high income earning household. They also have high expenses as well, excluding the mortgage. So we're not going to include this $4,527 payment. Their expenses are approximately $10,000 every single month. That is childcare, groceries, auto expense, entertainment, investing, setting money aside for other things, right? So they're putting in about $10,000 every single month, not including their mortgage, okay? We'll skip over the monthly account fee for now. We'll explain that in a future video. With this specific client, they're actually keeping a very large amount in the checkings and savings account. A lot of Canadians do the same. Now, is it the wisest thing to do? Debatable, but this particular client likes to be conservative, so they're keeping about $110,000 between their checkings and their savings account. They don't want to invest this money. They want to keep it there just in case. And the worst part of it is that this money is barely earning them any return. Even if it was to earn them 2% interest, for example, after taxes, that's equivalent to 1% interest, right? So if there's a way to take this balance and reduce their mortgage, that could be more beneficial. And that's where we get into the offset mortgage, aka the power of the paycheck strategy. Let's break it down. So then I explained to the client, the strategy simply put is, what if your checking savings account and your paycheck can help reduce your mortgage? In other words, your checkings and savings account and your mortgage account was combined together. The client looked at me confused. He thought I was joking, but this is seriously how an offset mortgage works, and this is the greatest strength of this mortgage product. So let's understand the flow of money and how it works. Let's say this client has a checkings and savings account, again, $110,000. And their net pay is $16,000. What ends up happening is that the mortgage is $750K, but it gets offset against whatever they have saved, so $110K. And because this net paycheck increases their checkings and savings, the checkings and savings account actually goes up to $126K. So this $110K plus this $16K. With their mortgage of $750,000, interest is not calculated on that. It's being offset against the checkings and savings in the paycheck. So if we subtract $750,000 from $110,000 from $16,000, the new mortgage amount is $624,000. So let's say that the rate for this product is about 5%. It is being calculated now on 624K instead of 750K. So irregardless of the small difference in interest rate, what we're seeing is that the amount of interest you pay on this product is going to be substantially less simply because the mortgage size is significantly smaller. And when this client withdraws $10,000 to pay for their expenses, the new mortgage amount is 634K because this withdrawal technically decreases their savings and checkings account, which means that the new mortgage balance is going to be slightly higher. So now 5% is calculated on $634,000. In either scenario, this is still cheaper than calculating interest on a much higher amount. And the beautiful thing is that this client is saving a lot of money every single month, so it allows them to compound and pay off the interest significantly earlier than a traditional mortgage. So just to understand how this works again, let's break it down. You have your main account, and that consists of a couple of things. Firstly, your mortgage balance, which is the $750,000 loan. Any withdrawals, that is like expenses, paying off your credit card, all of that, that technically increases your mortgage balance. Any deposits like your paychecks, tax refunds, any gifts that you deposit into your account reduces your mortgage balance. And then any checkings and savings accounts you have reduces your mortgage balance. Any sort of, let's say, high interest savings investments that you have can also potentially reduce your mortgage balance as well. So your main account balance is basically your mortgage balance, your withdrawals, your deposits, checkings and savings and investments combined. And your interest is calculated off of that. So if you are a saver, you're responsible with money and you are earning more than you spend, which I imagine most people should be able to do that, then this product can work wonders for you. And this is why it's worked so well for my particular client in this scenario. His next question to me was an obvious one. He said, Austin, this sounds amazing, but how come I've never heard of this product before if it's so good? And look, that's a totally fair question. Offset mortgages aren't new. They've existed for years. And in fact, in Australia, almost half of all mortgages are actually offset mortgages. They're popular in many parts of the world, not Canada though. And part of the reason is because Canada, most of the lenders are actually the big banks, and the big banks don't often offer this product. The reason being is because it leads to less interest being paid on the mortgage. The business of the bank is to loan money and make the most amount of interest possible. And the bank can only do that if people make their minimum payments. Your mortgage payment, think about it, is basically like a minimum payment on the biggest debt that you have. And as long as you continue to make that payment in 25 or 30 years, the bank will continue to collect interest in large sums from you. Here's something else to know. Australians with about $50,000 or more in savings, 2/3 of them utilize an offset mortgage because that's how powerful that tool actually is. And simply put, that's why this strategy flies under the radar, because not a ton of lenders offer it, and there's not much marketing behind it because it's not in the lender's best interest. Then the client asks, why can't I just leave the $110,000 in a high interest savings account? Fair question, but let's say that you have 110K here. The rate that the savings account is paying you is 2%. So maybe your return in dollars is going to be $110,000 multiplied by 2%, $2,200. The thing is that this income is taxable, but their marginal tax rate was 53.5%, okay? So even if they get $2,200 in interest, the government is going to tax them, right? So they're going to have to pay back $1,177. So their net profit is actually closer to $2,200 minus what they have to pay back in taxes. If I take this and divide it by their initial investment, their interest that they're actually collecting is 0.93%, not the 2%. Whereas when they take this $110,000 and apply it in the offset account, that is saving them on interest, and that interest is not taxable. That is net after tax return. When you pay off your mortgage, you don't have to pay taxes on it. So this is much more powerful. They're getting a 4 times return than just keeping it in a high yield savings account, and with less risk as well, because you're actually reducing leverage. After showing him the numbers, he nodded and agreed. Yeah, the math there checks out. But we didn't even get to the good part. The power of the paycheck is really the strength of this strategy. Again, as long as this client remains responsible, meaning that they're bringing in more money than they spend, they're going to naturally increase their checkings and their savings account. And as a result, they're going to be rewarded by that by paying less interest on their mortgage. And that is going to shave years off of their amortization. We're going to break down the numbers for this specific client and just show how powerful of a strategy it can be for them. Here are the final numbers for this particular client. We are comparing the 3.99% interest rate they got from the traditional lender to an offset mortgage where we assume the rate would be 4.95% to be conservative. And so after we ran all the numbers for the clients, the results were jarring. They would be saving $157,000 in interest, even with the slightly higher rate versus doing a traditional mortgage. And again, just to remind you, the benchmark rate we use for the client is 3.99% for a traditional mortgage. We use closer towards 4.95% for an offset mortgage to illustrate how much rate doesn't matter when you implement a strategy like this for this particular client. So almost 50% less in interest, which is already insane as it is. But here's the best part. They would be mortgage free in 12 years, actually slightly less than 12 years versus a traditional mortgage, which would take 20 years. And again, we're not asking them to earn any extra money. We're not asking them to save any extra money. Simply, we're taking their numbers as it is today and just plugging it in and seeing, okay, this is how much you can save by just choosing a mortgage product that is going to be more in line and more favored towards your goals. And here's the cool part. By doing an offset mortgage, the interest they actually pay on their mortgage is closer towards 2.23% when we compare it to a traditional mortgage, just because of the amount of interest they actually end up saving and how quickly they pay off the mortgage. Although the rate on paper may say 4.95%, they're effectively only paying 2.23% because of how quickly the mortgage is being paid off, and also because of the loan size being smaller over time as well. So if we break down the numbers further, we can see that with a traditional lender, they're going to be spending about $336,000 in interest, right? Which is going to take 20 years to pay off. With an offset mortgage, the starting balance is going to be slightly lower because we're going to use some of those checkings and savings number to actually offset that starting balance. And the monthly payment is significantly less as well because our balance is lower as well. So our monthly payment is $36.4267, so actually lower than the traditional mortgage. On top of that, we're paying off the mortgage a lot quicker. The interest we pay is slightly less than $180K because we're utilizing the efficiencies of the mortgage. And again, as I mentioned, the break-even interest rate is 2.23%. So let's look at this again in a chart. This is your traditional mortgage. It's going to take 20 years to pay off. And with an offset mortgage, we can see that immediate dip because we are utilizing the checkings and savings to reduce the balance. And we can see the massive gap between a traditional mortgage and between an offset mortgage. By year 5, we can see that gap is approximately $611,000 on a traditional mortgage versus $395,000 on an offset mortgage. So only 5 years in, we're already making a massive dent, and that gap gets bigger and bigger over time because we're using, again, the power of the paycheck to reduce the mortgage balance as quickly as possible. For this client who's super numbers oriented, they wanted to see the month by month breakdown between a traditional and an offset lender, and we're able to do that. We're able to show the side-by-side comparison, an annual comparison, current lender, offset only. Of course, we went into detail on the breakdown, but once we went over all the numbers, the client said, Austin, this is the mortgage I want to go with. It hits all of the goals that I'm looking for. How do we get started? So we went to the process of collecting the documents, getting the approval, and now this client is well on their way in paying off their mortgage years earlier. The amazing thing is that we are now layering on other advanced strategies as well, such as the Smith maneuver to help build the client's investment portfolio for retirement now that they're able to pay off their debt a lot quicker. See, understanding your particular goals is extremely important when creating your mortgage strategy. Many people focus on rate, which is important, but Strategy is oftentimes neglected, and that could cost you tens, if not hundreds of thousands of dollars, as I've shown in my last couple of videos. So if you want to learn more about the offset mortgage and the power of the Paycheque strategy, I actually put together a free mini course. You can access it down in the description link. And if you gotten value from this video, would really appreciate a thumbs up, subscribe, share this with a friend. It helps me keep producing high quality content like this. And lastly, if you're looking to work with an honest mortgage agent that focuses on strategy first, feel free to book a free discovery call with me. You can do so down in the link in the description.